Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and today we are on part 4 of our Learn to Trade Options series. This is the last part in our beginner options series to help you better understand how to take what you've learned over the past 3 weeks in terms of options education and show you a more practical side in terms of helping you understand how to actually place some of these orders, how to close some of these trades in terms of options trades within your first trade account. So we're going to go over everything from order entry, the things that you need to know about order entry for options that are different from stocks. And then what we're actually going to do is a demonstration of both the desktop as well as mobile platform to show you how to access or how to utilize the First Trade platform to execute some of these trades. And so let's go ahead and get started here. Before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by talking a little bit about opening option positions, because the order to enter an options position is quite different from the order that you need to enter a stock position. So we're going to talk about what are the differences, what are the things you need to pay attention to. We'll also show you how you can utilize tools like Options Play, which are available to First Trade customers, to analyze your trade and actually automatically set up your option open orders. Then we'll take a look at closing options positions, what you need to be very careful of when you're closing an options position. And then I want to talk a little bit about order pricing. So if you want to buy a call, if you want to sell a put, where do you place that order from a pricing perspective? What information can you get from the markets to help you better understand where to place those orders, which is linked to the discussion that I want to have around liquidity. A lot of investors, especially newer investors with options, I tend to look at the wrong metrics to gauge liquidity. So I want to have a conversation around how do you gauge liquidity on an option and understand where you want to place your orders based on that information. And then, like I said, what we're going to do here today is a full demo of the Options Play First Trade platform to show you how to enter an order and also how to close an order. We're going to show you both the desktop and the mobile platform. And then at the very end, we'll open this up for Q&A. So well, I'm going to do the session here today, but I'm also going to bring on the head of product development from First Trade, Jeff Huang, here in a little bit. He's going to give us a bit more in-depth walkthrough of the First Trade platform, both how to close orders as well as on the mobile platform. So that will be in a few minutes after I go through some of the basics of order entry, but we'll have Jeff here in just a couple of minutes. But the primary thing that I want investors to be able to walk away from today's session is a better understanding as to what are the best practices for entering and exiting your option positions and orders at First Trade. So my name is Tony Zhang. I'm the Chief Strategist here at Options Play. I have personally been trading options for more than a decade. So one of the things that I want to make sure that I impart on you is that there are a lot of things with order entry from options that are second nature to me, that for someone who's new to options trading, you might not find it as intuitive. So I want to make sure that I spend a few minutes to answer those questions and make sure that everyone understands what are the differences between a stock order and an options order, so that you enter the trade exactly the way you want, you're able to exit your positions correctly and not end up with duplicate positions or positions that you never intended on putting on. So let's first off by talking a little bit about what is different about an order entry for options. So before we get started, how many of you are relatively new to options? If you could please bring up your chat window, which is at the bottom of your screen. And if you could either type 1 into the chat window if you're brand new to options trading or learning how to trade options, or type 2 if you have some experience trading options, meaning you've already traded some options in your portfolio. Okay, so I see a lot of 1s. I see quite a few 2s, but I seem to see more 1s than 2s, meaning more of you that are new and learning than those of you that have experience. So that's exactly what this webinar is for. Again, this is a beginner learn to trade options course. This is the last step in the course, so I'll show you how to access the first 3 sessions where we talked about why you should use options, what are some basic option strategies, and today we're going to round it out with teaching you how to enter some of these orders from the strategies you've learned over the past few weeks. So the first and foremost, the most important thing to remember with an options order is that within the order, you actually have to specify whether the order, excuse me, Ooh, sorry. So within the options order entry screen, you actually have to specify whether the order is in order to open a new position or if it's in order to close an existing position. Unlike a stock trade, all you have to do is specify buy or sell, and they automatically offset each other. So if you're buying 100 shares of the stock and you later sell 100 shares of the stock, that sale will automatically offset the 100 shares of stock that you own in your portfolio. Vice versa, if you were to short sell 100 shares of the stock and if you buy back the stock later, that will also offset your short position. But with options, you can't just buy and sell an option. You have to actually specify within the order whether this is an order to establish a new position or if it's an order to close an existing position that you have. Now, just like a stock, you can either buy an option or you can sell an option to initiate the position. So when you either buy to open or sell to open, those are your 2 possible opening transactions. You're either buying or selling, you're either buying a call or a put, or you're selling a call or a put. The buying is typically a debit, the selling is a credit. So depending on which one you're ordering, whichever one that you're specifying, you must specify on the opening transaction both to open for either the buy or the sell. Now, on the flip side, when you're ready to close a position that you currently have, so either you own a call or a put, or you've sold a call or a put and you want to get out of that position, what you have to do, just like a stock, is that you have to trade the opposite transaction, which means that if you initially bought, you need to sell to get out of the trade, or if you originally sold, you need to buy to get out of the trade. But you must specify on that order that it is a to close order. So sell to close or buy to close are the 2 possible closing transactions. And you must make sure that you have the appropriate corresponding position. If by accident, let's say you bought a call option. So let's say you bought a call option at first, and when you went to go sell the option, instead of choosing sell to close, you accidentally create a sell to open order. If instead of accidentally placing a close order, you place an open order, what will actually happen is that you will now have 2 open positions. You will be both long the call and short the call at the same time. So the positions themselves in terms of P&L will offset each other, but you now have 2 open positions. You actually have exposure because on the short call option, you have obligations. On the long position, you have rights, and you are technically hedged in terms of P&L, but at expiration, you actually have some exposure. So that's why it's very important when you're placing an order for options, you must specify whether it's to open or to close. So for example, if let's say I have a bullish view on stock XYZ, and from the previous lesson that we just learned here a couple of weeks ago, you decide that you want to buy a call option on stock XYZ because you think that stock's going to go higher. So just to walk you through what you should expect when you buy that call option is you must specify buy to open, meaning you're buying a call option to open this transaction or establish a new position. You have to specify the quantity similar to a stock position. You have to specify the expiration date, unlike the stock position. You have to specify a strike price, unlike the stock position. You have to specify that this is a call option and not a put option. And then lastly, you have to pay a certain premium, the price at which you want to pay for that call option. So for those, as you can see, there are 3 of them that are similar to when you buy a stock. You have to specify whether you're buying or selling, the quantity, and the price at which you want to buy the stock. But when you're trading options, you have 3 new parameters: expiration date, strike price, and call or put, okay? So you have extra parameters. These are things that you must pay attention to. If you get any of these parameters wrong, if you flip a call to a put, if you select the wrong expiration date or the wrong strike price, you're going to find yourself in a position that's different than what you originally intended. So that's why it's so important to pay attention to what you're trading. Now, what I will show you here with Options Play is how Options Play automates some of this, filling in the order for you so that you don't potentially make any mistakes in trying to translate a trade that you're making into the order ticket. Does that make sense, everyone? Please type 3 into the chat window if the concept of buy to open, sell to close, or sell to open and buy to close makes sense to you. Okay, great. I saw someone saying that they made a mistake before, and again, that's, it's okay, but we're here to hopefully help everyone avoid that mistake from the first get-go. So whenever you're trying to establish a new position when you're trading options, the first thing you want to do with your order entry is establish a directional view. So you have a stock, you're either bullish, bearish, or neutral on that stock. So depending on what your views are, you're going to select an appropriate option strategy for that view. So if you're bullish, you might buy a call option. If you're bearish, you might buy a put option. If you're neutral, perhaps you're selling a call or put. But regardless, you pick an option strategy that aligns with your view of the underlying stock. You have to pick an action, which is the buy to open or sell to open. You have to specify the quantity, the expiration date, strike price, and call put with a price. And you must always use a to open order when you're establishing a new position. Now, what you want to do is you want to place that order either using a limit price or a market order. Those are your generally two types of order types that you could use to enter an options position. Today, what we're going to do is we're going to walk you through a limit order. I think limit orders is predominantly where most of you will use. And if you're brand new to options trading, I recommend that that's the only order type that you use. A market order is suitable only if you're a very experienced options trader or if you absolutely need to get out of a position and the price that you pay is less important than getting out of the trade itself. That's the only time where you may want to use a market order. Now, as we learn more about options trading, you're going to find that you can trade what we call multi-leg options, meaning there are some times where you're not just buying a single call option, you might be buying a call and selling a different call in a single order. This is what we call multi-leg options orders. Now, whenever you come across a multi-leg options order, whether you're trading a spread like a calendar, a diagonal, a debit, a credit spread, or even more advanced strategies like straddles, strangles, butterflies, iron condors, these are all considered multi-leg strategies. A lot of questions that I tend to get from investors is, do you enter all of these orders in a single order? And the answer is yes. You always enter a multi-leg order as a single order. You should never, ever break them apart. If you're an extremely advanced trader, perhaps there are some, I would say, unique scenarios where you could potentially make some more money or eke out a slightly higher profit by breaking up a multi-leg order. But most of those times, you're also taking on additional risk, which is why I don't recommend for investors, especially for those of you that are new, if you're ever trading a multi-leg order, you always trade it as a single order. We're going to show you how to enter these multi-leg trades as a single order inside of your first trade account. Now, once you've established that position, let's say you buy a call option because you think a stock's going to go higher, so you buy a call option that expires sometime in the future. Now, let's say the stock makes a big move in the direction that you expected to, or the stock declines, it's not going in your favor, and you simply want to get out of the trade. You're ready to get out of the trade either at a profit or a loss. And I always recommend for investors, before you get in the trade, let's say you pay $2 for a call option. You should always have rules set up ahead of time that tell you when you want to take profits. So let's say you buy a call option and it increases from $2 to $4, you choose to maybe take profits. Or if it goes from $2 down to $1, you decide to cut losses. Now, these are rules that I generally recommend investors to establish before you ever get into the initial position. because these are rules that you should establish beforehand so that you're not figuring out on the fly while you're in a position when you want to take profits, when you want to cut your losses. You should have these things figured out before you get into a trade. So as soon as the stock triggers one of these levels, you, from a rules-based approach, start closing positions as a result of that. That helps remove some of the emotional complexities that we have when it comes to trading. A lot of times you buy a call option or you buy a stock, maybe you're profitable or maybe you've taken a loss here and you're trying to ask yourself, should I stay in the trade or should I get out? You know, you don't want to be trying to make a decision on the fly. You should have a rules-based approach so that you know exactly when you get out and exactly when you stay into the position. It shouldn't be a question. You should have hard, fast rules. So I always encourage investors, set the rules ahead of time. And when you're ready to close a position, so let's say you buy a call option for $2, and now it's increased in value from $2 to $4 and you want to take profits. So at this point, what you have to make sure you do is you enter a to close order. Now, we will do here is show you, and Jeff will show you here later today, using the First Trade platform, how you can select close on an existing position that you see in your First Trade account. So you don't actually have to enter the order manually. There will be a button that you can see that it will show you close position that will automatically enter the order for you. Now, on closing positions, just like opening positions, whenever let's say you have a multi-leg position, you always want to make sure you close that as a single order. You never want to, again, break up a multi-leg order into multiple orders in order to place that trade. You always want to keep multi-leg positions as one whole position. You enter as a whole position and you exit as a whole position. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 4. So let's go ahead and move on. So let's talk a little bit about options pricing. And once we talk a little bit about option pricing, we're going to go through some examples. So up till now, I've talked about this in more theoretical terms in terms of entering an order. But one critical piece of your order entry with respect to options is the price at which you enter your options for. So for example, if Apple stock is trading at $130, the spread between the bid-ask price many times is a penny or even fractions of a penny. So most traders will typically place their limit orders at where the current price is trading, because the difference between the price that you can buy the stock at and the price that you can sell the stock at is usually a penny, maybe even less than a penny. So most investors don't sweat it if they're buying at $130 or $131, $130.01 or $129.99. For most investors, those are kind of fungible, if you will. But when you're trading options, the difference between the price that you can buy at and the price that you can sell at typically is much larger from a percentage perspective, not only from a dollar perspective, but also from a percentage perspective. So a lot of investors tend to get a little confused as to where they should place their order entry. So I want to talk a little bit about how option pricing works to give you a little bit more insights into how these prices even come about and how you can use that information to your advantage when you're placing an order. So whenever we think of a market, there are two sides to a market. There's a bid price and there is a asking price. So these are the two prices that you see displayed when you look at a quote for an option. Now, many investors ask, what is a bid-ask quote? What does it actually represent? The best way to think about it is that a bid-ask quote is simply, you should think of the markets as one big auction. What you have on the bid and the offer are simply just the best prices for the current auction. Now, there are buyers and there are potential sellers out there for this particular auction. So when we see a bid price, that represents the highest price someone's willing to pay for a specific asset. Now, it doesn't really matter what this asset is. It doesn't matter whether this is, let's say, Apple stock, or this is an Apple option, or if this is a future or a currency. It doesn't matter what the asset is. The bid and ask quote always represents the bid price always represents the highest price someone's willing to pay for an asset. In this particular case, $7.75 represents the highest price anyone's willing to pay. And many times that means there are other people below it, meaning someone's willing to pay 770, someone's willing to pay 765, and there are plenty of bids out there, but 775, the one price that's displayed, is simply the highest offer someone's willing to, is the highest price someone's willing to pay for that one asset. On the flip side, the asking price is the lowest price someone's willing to accept for that asset. So this is the lowest price someone's willing to sell. Now, that doesn't mean 7,795 is the only price. Someone else might be willing to sell to you for $8 or $8.05. But what you get displayed are only the highest bid price and the lowest asking price. That's how you get a bid ask quote out there. Now, many times when you're trading options, you will also see a price called the mid price. Now, the mid price is simply just an average between the bid and the ask price. But the mid price is actually a calculated, it's a calculated metric, meaning it's not a metric that anyone is displaying anywhere. We're just simply averaging the highest price someone's willing to pay versus the lowest price someone's willing to offer. So the mid price is simply a calculated value. It's not something that's actually disseminated by anyone. It's not a real price for anything, but it is very valuable in using this. So what I want to do is I want to make sure everyone understands how bid ask price works and why we use this for our options trading. So before I move on, I just want to make sure, does everyone understand what a bid and ask quote actually means? Please type 5 into the chat window if that makes sense to you as to what the bid and ask quote is telling you on your screen. Okay, perfect. So just to give you a bit more of a glimpse into how the sausage is made, many investors will ask, well, how does the market know what they're willing to pay for it and what they are willing to sell for that security, right? So this is really where we have to take the opposite side of the trade for a second. So you as an investor, you see the bid price and you see the asking price. You can think of the bid and the ask quote as kind of the price, the sticker price that you see when you walk onto the car dealership, meaning that's the firm quote. Whenever you have a bid price and an ask price, these are firm quotes. This is a market maker or a participant in the market saying that I will buy at this particular price from you if you take this price. I'm committing to that order. Same thing on the asking price side. But if you think about how does someone actually come about and saying, I will guarantee that I will buy from you at 775 and I guarantee that I will sell to you at 795, how does that come about? Well, let's do a little reverse engineering. And this requires an understanding of how a market maker, meaning the computer algorithms that are on the other side of this trade, how do they think about where they place their bids and where they place their asking quotes? Because you can think of, again, those two quotes as the sticker price that you see when you walk onto that car dealership, right? So when you walk on a car dealership, you see the sticker price on the car is $30,000. Do you walk on that car dealership and do you pay $30,000 for it? Absolutely not, right? We always try to negotiate. We always try to say, okay, I know it's $30,000, but I'll offer you $28,000 or $27,000. But the problem with a car dealership, the problem with it is the fact that you don't know what the fair value of a car is, right? So let's say you see the sticker price is $30,000 and you offer the car dealership $25,000, but the problem is you don't know how much the car dealer bought that car for, right? Maybe they bought it for $27,000. If they bought it for $27,000 and you offer them $25,000, they're likely going to reject your offer, right? But if you, let's say, offer them $28,000 or $29,000, maybe at that point, that's when it makes sense for them to accept your offer when you're inside of this range, above the fair value, but below the sticker price. So guess what? The mid price actually represents a pretty close representation of what the fair value of an option is. Why is that? It's because the market maker on the other side of your trade actually has to, number one, calculate what is the fair value of an option in order for him to, or her, or rather the computer, to decide how much of a markup to charge you. So what the mid price, which is something we calculate, what that actually, the information we get from the mid price is actually what the computer algorithm is roughly estimating as a fair value for the option. So when we see that the bid price is $7.75, we see the asking price is $7.95, we can roughly safely assume, now it's never on the penny, meaning we could be off by a couple of pennies on either side, but we can safely say that the fair value is somewhere in between these two prices. And generally speaking, most market makers will mark up relatively equal amount to the upside and equal amount to the downside. So this is how market makers think, right? They know that this thing is worth $7.85, but if I'm going to buy from you, I'm going to buy it 10 cents cheaper than what the fair value is. And if I'm going to sell to you, I'm going to sell 10 cents above where the current price is. So this is how a market maker thinks. And that is what you can use for your information when you're placing an order. Because when you're placing an order, what you know is the bid and the ask price. And from that, you can calculate a mid price from that price. And when you're placing an order to buy, well, guess what? The market maker will always want to charge you some markup, but you don't have to pay the sticker price. That's the lesson to learn here. What you want to learn is just what is the fair value of something so that you can start working your way up to the asking price, up to the sticker price, just like in the car example. If let's say the fair value of the car is $27,000, the sticker price is $30,000, what do? You start at maybe $27,500. And if the car dealer says no, then you work your way up to 28. And if he still says no, you work your way up to 28.5, right? That's how it works. Same thing with an options order. If you think that the fair value of an option is $2.75, maybe you place your order at $2.77. See if the order will get filled. That's how an auction works. And the great thing about markets is that nothing stops you from placing orders, throwing a price out there, and seeing if anyone wants to interact with your quote. The good thing about computers is you don't have to wait very long. If they like your order, they'll basically accept it within a fraction of a second. As long as you mark it up, as long as they're making a profit on the trade and they feel that the profit is large enough, the market maker will accept your order. You don't have to pay the sticker price. Vice versa, if you're selling an asset, if you're selling a call or a put, guess what? You're going to have to sell it at below fair value. Now, that doesn't mean that you have to sell it at the rock bottom price that the market maker wants you to buy it at, or the guaranteed price that they're willing to buy it from you at, which is the bid price, or what we consider the advertised sticker price. What you want to do is you want to negotiate, right? Imagine walking into a car dealership and wanting to sell your used car, right? Maybe you know that the car is worth $10,000, but the car dealer is offering you $8,000. That's exactly what the bid price represents. So what do? You negotiate. You say, no, I'm not going to accept $8,000. I'll accept $9,500. Maybe the car dealership says, no, I'll offer you maybe $9,000. And you can just keep going lower and lower until you get to a price that both of you can agree to. But that's why the mid price is so important. The mid price is not a value that's disseminated by the market. The market only disseminates a bid price and an asking price. We calculate the average between the two, and that gives us a pretty good sense of the fair value. Does that make sense, everyone? Please type 7 into the chat window if the mid price represents a fair value makes sense to you, and why, when you're buying, you need to work your way up by placing a small markup on that fair value. And if you're selling, you need to provide a small markdown from that fair value in order to get the market makers to play ball with you. But remember, you should never, ever pay sticker price or offer to sell something at the sticker price. Always negotiate your way through this, okay? So with that, what I want to do now is let me just do, well, actually, yeah, at this point, let's bring on the platform. Let's show you some real examples, because I think we've went through enough theoretical examples. Let's go through some real trades. So what I'm going to do is I'm going to bring up an options chain, right? So let's bring up first an options chain. Here is Apple. Let's say I'm going out to March. And let's say I want to buy a 130 call option, which is roughly the at the money call option for March for Apple, because I think Apple's going to go higher. So I want to buy a call option. I'm going to buy a March option, giving me a little bit of time between now and expiration. The 130, the at the money call option, will cost me between $9 and $9.15. That's the bid ask quote that the market is telling me. So I'll know roughly that the fair value is around $9.07, $9.08. So if I'm placing an order here, all I have to do is place the number of contracts. As you can see, the platform automatically selects the expiration date, the strike price, the call or put, and all I have to do is place a limit price. So I know the bid ask is 9 by 9.15. So just to show you what I would, excuse me, what I would do as a trader is I would probably enter this in for $9.08 as a starting point, half a penny above the midpoint. Just see if the market maker is willing to play ball. Now, Apple is very, very liquid. So the more liquid something is, the less of a premium they're usually typically charging on the markup. If it doesn't get filled at 9.08, I might work my way up to 9.09 or maybe $9.10. Usually on a liquid name like Apple, usually don't have to move by more than a couple of pennies off of that midpoint in order to get filled. Now, you can also use the options play tool, which is available to you on your options wizard screen. This is a tool that's available to all First Trade customers completely free of charge. This allows you to analyze option strategies. So for example, if you're bullish on Apple, it'll show you option strategies that you can deploy for Apple and see them side by side with other strategies, compare that call option, see your risk or rewards of each strategy before you place that trade. And then I'll show you how to execute those trades within your First Trade account from your options play tool. Let me see what's going on here. So you can also launch, by the way, you can also launch your options wizard from your options chain, right? So when you're looking at your options chain, as you can see, there's a link here for options wizard. If you click on that, it will launch the options play tool. So let me just log in here for real quick, and I'll show you how to access the tool or how the options play tool is automatically linked to the First Trade order ticket so that you can enter your orders directly from First Trade. If I can't get this up and running, I will show you an alternative way to access this. 1 second. All right, so let's go back to options. You can go to trading and you go to options. So again, you must select a transaction buy or close, buy to open, sell to open, buy to close, or sell to close. We're not going to cover closing transactions just yet. We're going to do the opening transaction first. So you must select buy to open, the number of contracts. You can select your symbol, such as Apple in this particular case. You can select your expiration date. I was using the March 130s. You can choose whatever strike price you'd like. You must choose call or put. It's extremely important that you choose the correct one for the strategy that you're trading. And then as you can see, we'll always display to you the bid and the ask price of that option order so that you can place that order. Like I said, asking price is the sticker price. You don't want to pay the sticker price. You always want to negotiate your way down. And just to put this into context, right? The difference between paying $9.15 versus $9.10 is $5 per contract. So if you're trading one contract, $5 may not seem like a whole lot. But if you're trading 10 contracts, that's $50 that you're saving on your trade. That's $50 worth of less risk. That's $50 of more profit if it's a profitable trade. So it makes a big difference that those 5 cents make. Now, Apple happens to be a relatively liquid symbol, so the bid and ask quote is going to be relatively tight. But if you look at something that's a little bigger, so let's say you want to look at, let's look at something that's slightly less liquid. Let's look at something like Restoration Hardware. Let's go out to March again. Let's choose, let's say, a $500 strike price on Restoration Hardware. And we choose a call option. As you can see, the difference between the bid and ask quote here is more than $4. So there's a big wiggle room between where you can buy versus where you can sell and the price at which you can get executed. And the difference between paying, let's say, $37 and $38 is $100 per contract. So that means that if you're trading 10 contracts, that's $1,000 you could potentially save by understanding how market makers work. So this is just a quick overview as to how to utilize options or the First Trade platform to open a position. So now what I want to do is I want to bring on Jeff. I want to have Jeff show us how you can place a trade using the mobile platform, how you can close a trade during the mobile platform, and also how you can close an existing position using the desktop platform as well. So Jeff, can you hear me?
Yes, great.
Thank you so much, Jeff. So you can take the screen share if you'd like. Let me just stop sharing. You should be able to share your screen now. So Jeff is going to walk you through closing a position using the desktop platform first, and then we'll jump over to the mobile platform and show you the same thing, how to open and close as well.
All right. Can everyone see my screen? Not yet?
Looks like it's just starting. Yep, looks like it's up and running.
Okay, great. Yes, so today I'm going to demonstrate how to close an options spread. And so when you log into Full Trade, first thing that you see is your typical dashboard that contains all your account balance. Now to close a options or complex option is very, very easy. So the way that you begin this process is you simply go to your accounts and then click on positions. And then now this morning I placed a buy call spread. So just for today's demonstrations. So I did a WDAY this morning, and well, it actually did pretty well today. So we're going to demonstrate how to close this. Now this is past 4 o'clock, so you can't really execute this trade, but I'm going to just show you how to do this. And you notice that there are 3 dots here. These are the manuals. When you click on this particular manual, you'll be presented with these options. So the easiest way to close this particular spread is to simply just click on close spread. So once you click on this particular link, you'll be directed to the screen that Tony just showed. And so all you have to do is click on the symbol or the contract that you want to close, and it will populate one of the leg. And then you select the second leg. And once you get to this area, this is where you choose a net price. And so we can do just choose a net price, $8.45, and then to do a preview. Right now we are basically outside the market hour, so we cannot place this particular order. So this is how you close this particular spread. And you'll notice that the system will automatically choose all these transactions. It will change, to sell close and buy close. Everything's all populated for you. So it's very straightforward. So all you have to remember is just go to account and follow the little dots here and close spread. Okay, so this is the web version. I hope this is clear. And if I'm going to demonstrate the mobile version as the next demonstration. So I'm going to just switch to the mobile. Hold on one second. Okay, can you guys see my mobile screen? Oh, okay, great. All right. Okay, so when you log into your mobile, this is the newest version of the Full Trade mobile app. So with this particular versions, there's certain column arrangement that you can customize. So for this particular demonstration, I actually customize. This is sort of the the column that I would like to see. So anyways, if you want to, this is a side note. If you want to customize your column, you could go to My Account, edit position columns, and you can move up and down. Basically, these fields. These particular positions data point that you want to see. So when you come back to, when you come back to your position page, you'll be presented, your list of the options. And very similar to the web, all you have to do is click on, let's say I'm going to do the WDA wide close position again. I'll click on that particular symbol, and then I'll click on close position. Now, this particular entry was done as a call spread. So I'm going to change my strategy here, right here that you see, select a strategy to close. I'm going to select a spread and then click on done. And then I'll click on this area, select options to close. And again, it will autofill the other leg. So basically you have sell close, buy close, everything all populated for you. And now all you have to do is enter the net price. And then preview your order. Again, this is outside market hour, and then send your order. So this is how easy in this particular process is to help, these complex options that you can simply click on, close options, and you'll be able to select the legs and close all these positions. Now, for single leg, is very similar. So right now, I think I have, I have a cover call that is about to expire this Friday, and the AMD. Again, very similar to the spread right here. I'll just click on the AMD call, close position. Now, this is a single leg, and it will automatically fill the buy close, these direction for you. And all you have to do is, again, change the limit price. Right now it's only 5 cents left. Again, then just click on review order and send the order. So this is how you close a options on spread and single leg on mobile. Okay, and the next step I'm going to demonstrate is on using the mobile to place a complex options. We actually done a lot of work enhancement on these workflows. So the whole process is quite easy. So for today's demonstration, I'm going to just use maybe Neo. Fast and Furious. All right, so once you click on Neo, you can click on Trade Options. On the top bar, you see right below the price, strategy, and expiration date. I'm going to do a, for single options, it's very easy. You just basically pick your, price right here. Whether it's call or put, you can click on these two tabs to switch between the call and put. And then for expiration date, you click on the expiration date and a picker will pop out. And you just basically select the expiration date, and the data will refresh automatically. And you can scroll up and down to change all the price, and the data will automatically load. So for today's demonstration, I'm going to do a spread. So I'm going to change the strategy right now to spread. Change the spread and click done. And I'm going to do it maybe March 19. And the option train data will automatically load. So basically on the left side of the column here, you have the first column is called all the call data. And then right in the middle are your strike price. And then to the right, the third column is all the put data. So we're going to just pick a configuration, a order entry. And let's see, what is a good, you can, this particular interface is very easy to use. It's very much like, almost like a shopping basket. You can just click on the price. And so I'm going to click on let's say I'm going to do a $55. Okay, do a buy call on the 55, and then scroll down. Let's say I'm going to pick 75 as my second leg. And you see on the bottom, this configuration, this spread will show up right on this particular blue background area. Now, if you want to change one of the leg, and all you have to do is click on either the X, the little icon X, or simply just click on the leg that you just selected, and you can reselect another configuration. So I'm going to do 80. And then click on the right arrow, and it will take you to this spread order page, where it's all populated for you as buy open, sell open. And basically, you can change the number of contract that you want by simply clicking plus and minus, or just type in a contract, type in a number, and click on the net price, and you can basically enter your limit price that you want to pay for this particular spread order. Again, click on preview order and then send order. So this is how easy for anybody to construct a spread order.
Thank you so much, Jeff. I think that was really useful, and just showing everyone, there are multiple ways to trade here at First Trade, whether you're using the desktop platform, whether you are using Options Play, and I was able to get Options Play to work, so I'll just do a quick showing everyone of using Options Play again. So I'm going to use the same NEO trade that Jeff was suggesting. Let's say we're looking at NEO here, and I'm bullish on NEO, and I want to buy that March 55.80 call vertical. Maybe I want to modify it a little and change it to the 75 or 80 or whatever it is. I can make my modifications. But once you analyze a trade using Options Play, which is a powerful tool that allows you to use a P&L simulator and see if NEO was to rise in value, how much should you expect to gain from that spread? NEO was to decline in value, how much do you have to risk on that particular trade? So you can have a lot of analytics on each trade using the Options Play tool. And when you're ready to place that trade, you can hit the trade button, you can preview the order button, and we will actually pre-fill the whole order ticket for you. Everything is pre-filled for you. All you have to do is place an order. All you have to do is place the price at which you want to buy. So again, looking at the spread that Jeff was just talking about, the NEO March 55.70 call spread, in this particular case, the midpoint was $5.07. That's a theoretical fair value of this option. But the sticker price the market makers are asking us $5.20. So what I would do is I would use this information and maybe enter my orders at maybe $5.10. I'll give the market maker 3-cent profit off of their theoretical value, and it still saves me 10 cents from paying from the sticker price, and what that adds up to be is $10 per contract. So if I'm trading 10 contracts, that adds up to $100 that I'm saving off of paying that sticker price. And then once you've entered your order, you can go ahead and preview that order and send that off for execution. Like I said, with electronic market making these days, you should see an order fill within literally a blink of an eye. They should fill pretty quickly if it's a price that the market maker is willing to accept. If, let's say, $5.10 is not acceptable, meaning it doesn't get filled immediately, and you want to get filled, then maybe you move it up to $5.11, $5.12, $5.13. You can keep working your order. There's nothing stopping you from continuously working your order and getting the best possible execution price on an order like this. So with that, that covers what we wanted to share with you here today with respect to understanding a little bit about what are the parameters that you need to think about when you're entering an options position. Hopefully this gives you a little bit of an understanding as to how you can utilize the tools here at First Trade to enter your order as well as close out your positions in your portfolio, and doing it with as easy as possible in a few steps as possible, but more importantly, giving you some insights into how you should place your orders from a pricing perspective, because that can save you some real money, especially if you're trading 5, 10, 20 contracts. Saving a few pennies here and there will really add up in the long run for your bottom line. So with that, I just want to thank everyone for taking the time out here this afternoon. I want to thank Jeff for jumping on and showing us both the desktop and mobile platform. At this point, what we will do is we will open this up for Q&A. If you have any questions, there is a Q&A window, and there's a chat window and a Q&A window. If you could bring up your questions in the Q&A window, I will answer your questions out of there. The First Trade team is also online as well. So if there is any questions for First Trade, you can also ask them as well. So please look at your chat window, look at your Q&A window, and please submit your questions there. Okay, so RD is asking a question. When you place a limit order for a combo order, more than one order, so he's referring to a complex position like the one that I have here on my screen here for NEO, saying, will the order be executed if a part of the order is within the limit? Example of the limit combo order is placed. So RD, to answer your question, is that if you place a complex order, you will never get filled on just one leg. That's the whole point of a complex order, is that they will guarantee execution on both legs at the same time. So you will never get filled on one leg and not get filled on the other. Now, if you're trading, let's say 100 contracts, you could potentially get filled on 20 contracts and not get filled on 80 contracts, meaning it's not guaranteed that you'll get your entire order filled, but whatever portion of your order is filled, both legs will be filled. I hope that answered your question. Julia saying, I want to sell puts. Example, 5 orders for $2, strike price of $48, expiring January 29th. What happens if the stock hits $48 until expiration? Should I buy back stock at day it hits 48 when the order is executed? So Julia, this is more of a question as to how do you manage a short put. I'm happy to answer those questions, but that gets a little complicated. So, as far as when you're selling a put, your obligation is to buy the stock at 48. The question is whether or not you still want to buy the stock at $48 at expiration. If you no longer want to buy the stock, then you should buy back the put and get out of that obligation. But if you're still comfortable owning that stock, then you should not do anything. Let the stock be put to you, and you effectively own the stock at $48 minus the $2 that you collected. So your effective price of owning the stock would be $46. So it really just depends on whether or not you still want to own the stock at expiration. What's a good way to protect yourself / make a series of trades to protect yourself from a scenario where the losses can be many times the price of the stock itself? So I've heard things like butterfly strategies, but I have no clue how to do that on First Trade. So Shanak, the question. So here's the thing, is that you will never find yourself in that position if you never enter a position that puts you in that position. First of all, I don't know of any strategies where you're risking many times the price of the stock itself. There are strategies where you're risking more than what you're collecting in terms of premium. But, I think that if you're brand new to options trading, first of all, you want to start with simple strategies like cover calls. Those do not add risk to your portfolio. They actually reduce risk. Most option strategies are actually done to help you reduce risk. A butterfly strategy certainly does not risk multiple times of what the stock price is. So I think the best way to prevent that, number one, is educating yourself on the strategies that you trade, and only trade strategies that have limited risk. Many option strategies have limited risk, meaning the option contract in itself protects you against losing more than a certain amount. You just have to make sure before you place your trade, you know what the maximum amount you're willing to, that you can risk on that particular trade, and ask yourself, am I comfortable if I lost 100% of this loss, and can I survive to trade another day? So it's all about education, in my opinion. How do you determine the net price when closing the spread? The same thing. This net price doesn't change whether you're buying, selling, opening, or closing. The net price is the net price. The question is just whether you're buying. So in this particular case, I'm buying, so I want to negotiate my way up. If I'm selling, I want to negotiate on my way down. So it really depends on whether you're buying and selling, but whether it's opening or closing doesn't really matter. Hi guys, could you please explain the stop limit order, and is it possible to place such an order for multi-leg positions? If I'm not mistaken, you can only place a limit order for a multi-leg position. So a limit order is an order that guarantees price but does not guarantee execution. And a limit order protects you from that being the worst possible price you can be executed at. So for example, if I place an order at $5.10 to buy, then the limit order protects me from never paying anything above $5.10. I could actually get filled below $5.10. Just because I place an order at $5.10 doesn't mean that's where I get filled. I could get filled at $5.09, so I could pay less than what I'm paying. The limit order effectively tells the market what is the maximum price you're willing to pay. If someone's willing to execute it to you at a lower price, you actually will be able to transact at that price. But a limit order guarantees price, but does not guarantee execution. Biju is asking, can you explain the risks of breaking a multi-leg single order to multiple orders? The thing about that is that there are so many different combinations, but sure, let's just say that here's a 2-leg trade. And if I break this up, and let's say one leg gets filled, let's say the second leg gets filled, for example, in this particular case, and the first leg never gets filled. Now, originally what I wanted to do is trade a bullish trade on NEO, meaning I'm bullish on NEO, that's why I'm buying the at-the-money call, I'm selling the out-of-the-money call option. If the first leg never gets filled, what I have is, number one, just a short call. So a short call, number one, has unlimited risk. The spread that I traded before has limited risk, right? It only requires $5.10 or $510 per contract to get into the trade. If I'm short a naked call, I need to have thousands of dollars of margin in order to sell that short call. So off the bat, instead of spending $510, you now have to remove thousands of dollars in buying power from your account to execute the short call. You now have a bearish position, and now you have a position that has unlimited risk. So from my perspective, there's no good reason to break up a spread, because you could be trading something completely different that requires a substantially more amount of capital and potentially has unlimited risk, versus when you have a multi-leg trade like a spread, you have limited risk, they're capital efficient, and you're trading in the direction that you expect it to, which in my case, I'm bullish on NEO. I don't want to be short a call, which is bearish on NEO. So Biju, that's just an example of how breaking up a multi-leg order can completely change the trade itself. Edward saying, can you please demonstrate how to enter a limit exit order on positions based on your target profit? Sure. So let's say I have a position, and I'm going to use the workday position here. So this, let me just understand this trade a little bit. So this is a long put vertical here. So this is short the February 210, 230 put vertical here. Let me see if I can make another one that, okay, let's say this is the trade that I have here, right? So I'm short the 230s and I'm long the 210s. So in this particular case, what was this traded for? I collected $13 and paid $4.87. Let me just reverse engineer this, because I didn't place this trade, but I collected $13.33 for that, and I'm paying and I got collected $4.87. So in this particular case, this $20 spread collected $8.46. Now it's currently trading at, oh no, I'm sorry, that's the current position. The initial trade was established at $16.06. So let me just do a little math again. $16 minus $6.30. So it was originally traded for $9.70 in terms of credit. It is now trading at $8 something credit. So let's say I want to close this spread. let's see, Workday and Workday. Okay, so as you can see, the net price here is $8.43. I said before I collected $9 and something, 70 cents or so on this particular trade. It's now trading at $8.43. So maybe, for example, one of the rules that I have is that when a credit spread declines by 50%, that's time to start taking profits. So here would be roughly $4 and let's say 85 cents or so. So if I sold something for $9.70, once it declines to about $4.85, it's time for me to get out of the trade. So what I would do is I would place an order here to buy it at $4.85, and I would click on preview. That's an example of an order that I would place for a position that I have. I sold something for $9.70. I want to buy it back for roughly $4.85. So I'll place that order at $4.85. And when the market drops, if a Workday continues to work its way up and this credit spread expires and starts to lose value, which is what I want when I sell a credit spread, then I'll be able to take advantage of that using a limit order. So I hope that answered your question, Edward. Ralph is saying, do I need extra software to access options play? No, you do not. You just need to have an options trading account at First Trade. You go to First Trade. It's on your home screen. As you can see here, your options wizard, launch options wizard. Also, like I said, on your options chain, there's a link to it on your options chain. So you can access it from multiple places. How can you roll a position to the next month? So that requires trading a spread. So this is something that we're still working on in terms of having a single position that allows you to do that. So let's say you're trying to close a spread. We currently don't have a roll position here. That's something that we plan on working on next, but that's not something that we currently have a single click order for you to do just yet. Angelo is saying, can you place a limit order good to cancel on a spread on First Trade's platform? If anyone from First Trade wants to jump in and answer that question on the Q&A, I unfortunately do not know the answer to that question. Can you place a good till cancel on a spread at First Trade? Is there an approval process for purchasing spreads? Yes, you do need to apply if you do not already have a level 3 access to options trading. You need level 3 access in order to trade spreads. Thank you for answering your previous question. Are complex orders available to trade on the offline or after hours? No. So there are no options trading at any platform after hours. Options trading are limited to 9:30 to 4 p.m. on all exchanges and brokerage firms. Are options dangerous and risky compared to buying stocks? Many people don't do options because they claim it's like gambling. So I can't help again but to reiterate what that comes down to is a lack of education. So there are plenty of ways that the reality is that there are a lot of ways that you can utilize options. If you want to apply a high amount of leverage and gamble your money, you certainly can do so. But that does not mean that you have to do so. There are many ways that you can actually conservatively use options, limit your risk. And for those of you that are in the process of learning, one of the things that you can watch is CNBC every single Friday at 5:30 p.m. There's a show called Options Action. That's the show that I am on every single Friday. And what we try to highlight on that show are trade ideas that we have, stocks, ETFs, indices that we have a bullish or bearish view on, and we highlight to you how we use options to take that directional view, but do so in a way with less risk than if you were to buy or short that stock. So my mission as an options investor is always to reduce risk. Otherwise, I would be blowing up my accounts all the time. So how can I successfully use options long-term in my portfolio? A great way to learn is by following someone like myself on CNBC. Now, if you want to learn more, there are lots of ways that you can learn. First Trade offers a variety of education. I highly recommend that you go to your research and tools page under Options Wizard. We have a whole set of webinars that you can learn on how to trade options. We have a complete options trading course from beginner, intermediate, and advanced. We have our video archive, and the current Options 101 course that you're currently taking is also available here on this page. So if you're learning and you want to learn different strategies, feel free to utilize the link here on your screen, which I just posted into the chat window for anyone who wants to go through the options education. You can learn how to generate income. You can learn how to speculate with limited risk using options. So I think that's specifically the question that Y is asking is, how can you trade options with limited risk? That's something we just highlighted here last week. So I hope that you're able to watch that video. So I suggest that you watch it in sequence. Get the first one, introduction to options, understand how to generate income, then learn how to speculate, and then lastly, entering orders, which is the one you're on here today. Once you complete all four, you'll have a much better understanding as to how you can place your first options trade. Julia is saying, I don't understand the concept of selling puts. After selling puts, stocks will automatically added to my account after it hits strike price. So Julia, when you sell a put, you will only own the stock if the stock is below your strike price at expiration and you keep that put option, meaning you don't close it before expiration. If the stock price closes above your strike price, then whatever premium you collected on the put, that's yours to keep, and that's it. You keep the premium and you can sell another put if you like. But if the stock trades below your strike price, then you own the stock plus the premium that you collected. Are the prices for the total amount of the option contracts charged per each of the shares in contract in reference to the bid-ask calculating? Yes, so bid-ask prices are always per share. Each contract represents 100 shares. So when you see something for $4.87, it will translate to $487 per contract because each contract represents 100 shares. Can you do an example of closing a spread call order with a limit price? I think I just did that with Workday. You're just basically closing the spread here. Like I said, this isn't my position, so I had to do a little bit of math here, but I think this was originally sold for about $9.70, and now I'm trying to buy it back for, let's say, $4.85. So I would place a limit order in this particular case for, let's say, $4.85. And click on preview order. Michael, thank you so much. I really appreciate it. How can you know the percentages that you're winning in a position? So Carlos, that's going to require a little bit of math on your end. But as you can see, you have the P&L here on your, right here, gain loss on each position. That's your P&L. If you have a vertical credit spread, can I enter an OCO order so that if there's a profit, I can close out? Ralph, I do not believe First Trade currently has OCO orders on spreads, but you can confirm that with First Trade. I don't want to speak on their behalf. If I have several calls and I want to close some, how do I select which ones to close first? Lewis, you don't have to specify what you want to close first, nor does it matter which one that gets closed first. Because from a tax, if you're concerned from a tax purpose, there's no requirement from a tax perspective to do first and first out. You can report any sale that you want. So if you have some that are maybe long term and you want to save those for long-term capital gains, you can. If that's what you're asking, but you don't specify which ones you close first. Everything ends up averaging out at the average price. Okay, that answers all of the questions here for today. If anyone has any more questions, or rather, I just want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of options. Like I said, this is the fourth step in a Options 101 course. So if you're joining us today for the first time, I highly recommend you to go back and watch number 1, number 2, and number 3, which are designed to help you get started. If you felt that today was a little over in your head, you felt that you were a little overwhelmed, you didn't understand it, that's okay. You're jumping in here towards the end. Start from the beginning, the Options 101 course. We have a lot more information to you. Also, we have a complete options trading course that we completed in 2020 that you can take at any time. I highly recommend it. And then we have a lot more options education video as well for those of you that want some more advanced topics or brush up on certain types of strategies and making sure that you understand the best practices for all of these different strategies. So with that, thank you so much. I hope you guys have a great evening, and I'll see you guys here in a couple of weeks on our next course.